My name's Tyler Hay. I'm the CEO of Evergreen GovCal. I'd like to welcome you tonight to the 8th annual Evergreen Outlook event. I'm told the turnout is almost 400 people. I'm confident that if we had not set the precedent of an open bar in years past, there'd be far fewer of you here tonight. The audience is comprised of clients, business partners, friends of the firm, and other interested parties. I'd like to say a special thank you to our clients who are here tonight. The trust you've instilled in us to manage your investments is an honor that we embrace with the highest sense of responsibility. The panel before you tonight is highly reflective of the money management process at Evergreen. First, investment decisions are made on a committee basis, not by a single individual. Second, they're forged through exhaustive discussion and often spirited debate. Lastly, our guests tonight characterize our commitment to agnostic investing. We do not believe that we have a monopoly on good investment ideas, and we know that our clients expect us to use every means possible to identify sound investment opportunities. Close collaboration between our firm and tonight's guests offer a distinct competitive advantage for our firm over others. Originally, our Director of Wealth Management, Jeff Uhlberg, and I were slated to give prepared remarks. Instead, we'll join other speakers for the Q&A following tonight's presentations. To call our guests this evening rock stars in the financial community might sound like an oxymoron, but is perhaps an understatement. Mark Nicoletti, the Director of Evergreen's Family Office, will be quarterbacking tonight's event. Mark, come take us away.
Thank you, Tyler. I drew the short straw, admittedly, to keep this thing moving tonight, so we'll see how it goes. I'm sure many of you watched the Olympics the last couple of weeks, and the downhill, the alpine skiing downhill. If you imagine a skier starting about 15% of the way down the mountain in the race, that's kind of like us having a 2014 Outlook event virtually in March. So. But hopefully we get a reprieve, because two of our guests, it was a bit of a challenge. They live in Hong Kong and Singapore, our guest speakers. So a couple of housekeeping notes. First, I wanted to have all my colleagues stand up briefly. I believe I have 26 or so, many of whom are here tonight. And I'd like to point out one in particular, Lindsay Hall, who's sort of our utility player, if you will. This event would not have happened without her. If something tasted good, looked good, smelled good, it's because of her. So thank you, Lindsay. On the contrary, if the wine's not the right temperature, or the hors d'oeuvres are under-seasoned, or you don't like your seat, I'd like to reintroduce Tyler Hay. He's our human complaint box, so warm my heart if he has a long line. Take your best shots afterwards. I'm personally very excited to have to get to introduce these three fellas. I have the utmost respect for all of them, and it's really an honor to call them all colleagues. Most of you know who David Hay is. CIO, Chief Investment Officer of Evergreen GovCal. He's also the author of Evergreen Virtual Advisor and one of our lead portfolio managers. He doesn't like me talking about two things, so I'm going to do both. How long he's been in the business, 35 plus years?
No, don't exaggerate. It'll be 35 years in 2 weeks.
34 plus years. And he's got a penchant for talking about all of his, for being self-effacing, for talking about all of his missteps. So I'm going to do the opposite. Some of his most notable calls were the tech bubble of the late 90s, the housing bubble in 2006, and then aggressively participating in the recovery in 2009. So it's my pleasure to introduce David Hay.
Thank you guys all and ladies for being here. We really appreciate it. How do you like the weather we arranged, though? I mean, that took some doing, but actually took a little bit more doing to get Louie and Grant to get here. And as Mark pointed out, this would normally happen in late January, but we thought it was more important to have Louie and Grant and delay a little bit. So thank you again, and we do have a fair amount of ground to cover, so we're going to try to make this a little shorter presentation, certainly from my standpoint, than you're used to in the past. I know that's really good news. So, I think we've all heard the appropriate, in this case, saying, often wrong, but never in doubt, very good. And I have to admit that I've used that a few times in my newsletter and maybe even when I've been conversing, but it's kind of embarrassing to have to say that about yourself. But that's really the way it's kind of been here lately, is the last few years, even though I've felt fairly strong convictions about some of the forecasts, some of those haven't worked out. And I've learned something that I really didn't expect before, which is that if you're wrong about the stock market, you're just plain wrong. It doesn't matter what your other forecasts have been, you're just not going to get a whole lot of credit. And I do want to remind people, though, that maybe got the wrong impression. We weren't bearish on stocks a year ago. We were just neutral. That was our official forecast, was kind of a sideways market. Obviously, that was still a big whiff. And I think it's reasonable for those of you that are clients in the room to wonder why. Why did we miss that? Why weren't we more aggressive? Certainly, we were in the market. It's just that we had some hedges in place that definitely undercut the stock market performance. And one of the reasons is that if you were to look back a year ago on the chart would be your left, and that orange dot that you see, that basically shows where the stock market valuation was a year ago. And this is Warren Buffett's favorite way of looking at the stock market, by the way. This compares total stock market valuation or capitalization to the size of the U.S. economy. Very, very high. Very few points in time in the past where it was worse than this, more expensive. And again, that was a year ago before a 32% increase. But also, I would point out, we don't look at just one of these. We look at multiple long-term valuation measures of the market. And one of our favorites, in fact, my personal favorite, is price to sales. Everybody talks about price to earnings, PE, but we like to look at price to sales because sales are much more predictable. Earnings, as we're going to see in a bit, are extremely volatile. Another reason why we were somewhat apprehensive, if you look at the chart on the right, the blue line shows you the stock market performance. Basically, that's a world market, not just the U.S. market. And the brown line is showing you economic surprises, good news, bad news. And what you can see is since the global financial crisis, there's been a recurring pattern of kind of a peak toward the end of one year into the next year and then a fall off. And in the first few years, the markets kind of track that. But you notice what happened the last couple of years, complete disconnect. The economy, as we all know, has been okay. It hasn't been great, but it's been okay, and yet the stock market has been red hot. Very unusual disconnect, and we'll talk about why that happened here in just a little bit. But I did want to do a quick review of our other 2013 anticipations. I mean, I've got them up here. I really don't want to, we're too time pressed to go through all of them. The biggie that you guys, many of you care about and should care about, that we really did get pretty right was our call about bonds. As many of you know, a year and a half ago, we really changed our tune because we made, for those of you that have been clients for 5 or 6 or 7 years, very substantial gains on income investments coming out of the meltdown in 08-09. But about a year and a half ago, we became concerned that the great bond bull market that had started in the early 80s was coming to an end. And boy, did it. It actually reversed a lot quicker than we thought. So very different than the stock market. So major sell-off occurred actually last year, right after Ben Bernanke started talking about the taper. The joke was it was the taper tantrum. And I think that's a pretty good way to characterize it. And unlike a lot of firms, we did actually go into action at that point and bought quite a bit of very depressed income securities at that point. And for you that are clients, I tried to emphasize this repeatedly in our newsletter, we were literally locking in yields of 6 to 8% for years during that panic selling that affected the yield world. And in some cases, toward the end of the year, when tax loss selling kicked in, we actually got 2 investments that were yielding 12%. And they both, fortunately, have appreciated since then, knock on a lot of wood. So, and ironically, since the end of the year, the stock market, even though it's recovered somewhat, it's still, I don't think most people realize this, it's basically flat for this year, for the first 2 months, which is unusual. Usually the market does well out of the gate, and yet the bond market's up about 1.5 points. So I think most people would not realize that bonds are actually outperforming stocks in the first 2 months of this year. That might not continue, but that's the way it is right now. So another why did we fight the Fed? Why did we not say, hey, look, they're printing all this money, let's just ride along? Well, if you look back at 2000, 2003, the Fed was cutting interest rates frantically, and yet the market went down roughly 50%. 2007, 2008, once again, the Fed was cutting interest rates frantically, and yet the market went down almost 60%. So, the old saying, don't fight the Fed, hasn't been true a lot of times. But for sure, with QE3, And with the multiple QEs piled on top of each other, where they've now printed over and I say printed, which is a misnomer, they've created $3 trillion. It's actually electronic money reserves. They don't actually print, dollar bills like the old, we see the German, the old newsreels of the Germans going to the bakery with wheelbarrows full of Deutsche or Reichsmarks. So, but they have created still $3 trillion. And if you look at the linkage, this chart shows you the linkage between the stock market and the Fed's balance sheet. So there's been if you're statistically inclined, there's been a 90% correlation between the Fed creating money and the stock market going up. So this time around, the Fed has won. Although we would say the important phrase there is at least for now. And we're going to give you some reasons why maybe the for now is not going to be for too much longer. So let's get to this year and our main calls. The biggie, we think this will be a stock shock. So again, we're not neutral. We're, as far as I know, the only firm that we've at least read that is calling for a down year. And we think that a double-digit decline is likely, maybe even a crashette. And I'm not saying this end of the world. Frankly, I think for the way we're positioned, this will be very opportune. We'll be able to take advantage of it. And that's why we try to get defensive toward the tail end of bull markets, is so that we can pounce on the next decline. As far as bond and income investments, the good news is very different than a year and a half ago. We think that they actually will behave pretty well, kind of like they've done so far this year. But a key difference is we think the safer, the better in the income world. And that is a change, because as many of you know, and some of you have been involved with master limited partnerships for, Bert, in your case, I think 20 years, and they have been by far the best asset class that we've owned over that period of time. But right now, we're even worried about MLPs. So my point is, in the income part of your portfolios, we are trying to de-risk. We're trying to get even more conservative and go higher quality. Other forecasts, we do think that international markets, as you're going to hear from particularly Louis, will do better than the U.S. We think the economy will continue to be decent. This could likely be the best year we've had of this so-called recovery, which isn't saying a whole lot. Good news, we think inflation is going to stay subdued. I know some of you have heard me say this for years and years and years, and I got a lot of pushback because of all the money being printed, but we said you can't just look at printed money, you've also got to look at the velocity of money, which is, I think Grant will talk about, has collapsed. We think emerging market debt. In case you don't know, that's an area that's been pummeled. We think there's definite opportunities there, much better than U.S. junk bonds. A lot of you may not be aware, last year, the lowest rate of U.S. junk bonds were up 15%. Better grade junk bonds only up about 6%. High grade bonds were actually down. So you had a tremendous deviation depending on quality. We think it will reverse this year. MLPs and REITs, we think you've got to be cautious. They're likely to be collateral victims of a sell-off in the market. Commodities, we like gold and silver. I know that cost them some return last year. We still like them as central bank insurance for a small part of the portfolio. And we think that one of the best plays in currencies right now, buy Canada. We liked it a year ago. It's obviously traded down. The Canadian dollar is about 90 cents to the US dollar. We think buying Canadian bonds is a great parking place if you're worried about what might happen in the US. They're not printing money. They should actually run a surplus next year, believe it or not. We don't think there's going to be any kind of budget, fantastic Simpson Bowles type of thing, although now there's a little bit of an inkling that maybe they'll get their act together, but I'm still skeptical. And finally, I think one of the best ways to make money over the next 2 years is to be negative US small cap stocks. They are phenomenally expensive. They're about 50% more overvalued than a very expensive US stock market. So to justify these views, this is I'm only going to show you a few charts because of our time constraints, but these are some of my favorites, and this is right up there. So this was a survey done earlier in the year of the major Wall Street firms, and so the top line is global equities, and what it tells you is that every firm was bullish on stocks, and the bottom line is fixed income bonds. Every firm was bearish on bonds. That was going into this year. And as I already indicated, that's not looking so great so far. What this reminds me of, that I think you might appreciate, this is a chart right before the Super Bowl of what the United States populace thought who was going to win. And Tyler watched the Super Bowl from Las Vegas. I don't know why I went to Las Vegas, maybe to bet a little bit. And I guess they had a map of how the money was flowing. The betting was around the country. And it was apparently, it wasn't even the Northeast, it was just the Northwest. So that was not one of America's better calls. So whenever you see the consensus that much skewed one way or the other, it gets our contrarian instincts up. And right now, in the stock market, the consensus seems to believe, because again, all these major firms are saying the market's going to go higher. But look at this chart. We say kind of jokingly, are you smarter than a fifth grader? But I really do believe a 10-year-old looking at this chart would say, this looks like trouble to me. This looks like it could maybe go down. And the red line, if you can make that out, that actually is tracking these very high-frequency oscillations that we've been seeing lately. In technical term, it's called log periodic bubbles. Whatever, it has tended to be a signature of a late-stage bull market. We are seeing a number of warnings now that we didn't see a year ago. Did I think that it would get as extended as it has? No. But frankly, it is very, very dangerous. And if it goes higher, and it could, let me say right now, it could go higher. But the higher it goes, the more dangerous it becomes, and we'll have what we had back, unfortunately, a few years ago. So besides printing money, the other thing that's really been behind a lot of this, and frankly, not just recently, but longer term, not just the Fed's money printing, but what's happened with debt. I think if you look at this chart on the left, if you go back to when it really started to go vertical, it was in the early 80s. And frankly, that's when the financial markets really started to go ballistic, was starting in the early 80s. So a lot of what we've seen, and this isn't being negative, this is just being realistic, has been debt-driven. That's fine, but can we continue to increase debt as we have over the last 30 years? I kind of doubt that. The next chart shows margin debt, and I think this should be a real wake-up call, because margin debt has actually gone even higher than what this chart is showing. And the red line, what that indicates is the prior times that the margin debt has gotten very high and what stock market performance has been over the next 2.5 years. And the right-hand scale is inverted, so when the red line goes up, that means the market's going down. When the red line goes down, the market's going up. So what it tells you is when margin debt gets very high, fasten your seatbelts, it's going to be a bumpy ride. And that's exactly what it's saying right now. So again, not trying to be negative, just trying to be realistic. Now the other thing, and this has been a good thing, has been corporate earnings have gone up very, very significantly. But the reality is corporate earnings are extremely cyclical. And the reason that you hear a lot of people say, oh, don't worry about the stock market, it's reasonably priced, it's because they're using peak earnings. And as you can see, it does appear that the earnings cycle is turning down. So that is why you have to look at something that's besides just a pure PE, like the price to sales ratio. But don't take my word for it. I want to show you something that comes from the firm that's got the best reputation for long-term asset class forecasts. It's a Boston-based firm, GMO. And what they're showing, if you look at the chart on the left, is that on large cap US stocks and small cap, negative returns over the next 7 years after inflation. Now you notice that there is a green bar that's positive, and that's for high quality. And that's because high quality companies have really been lagging for a long time. It's been the lower quality companies that have been dominating in most recent years. And actually the chart on the right, what that shows you is that high quality stocks are inexpensive. When the blue line is up, they're cheap. When the blue line is down, they're expensive. So that's good news, is that there are high quality companies that will likely hold up much better than certainly small cap when the worm turns. And that's why in our portfolios, our Evergreen portfolios, we are skewed toward those higher quality names. And we also are starting to buy emerging markets, which have been, as many of you know, they've been hammered pretty severely, and I know Louis will talk about that more. One of our other gripes is there's just a lot of optimism out there right now. This on the left is a headline that just appeared on over the weekend in the Wall Street Journal. Individual investors charging into the market. Trading activity at E-Trade and TD are now up 30–40%. You're in the article, they're interviewing people that are discussing giving up their jobs so they can day trade full time. And that's the kind of stuff that we had in the late 90s. It's crazy, it's insanity. What was it, the transaction that just occurred? Facebook is buying WhatsApp for $19 billion. You know what their revenues are? $20 million. I mean, that's a little bit heroic to assume that they're worth $19 billion. So and also on the right, we have the Citigroup panic euphoria, so they measure whether people are really bullish or really bearish, and it's at a very high level. Every time it's hit this in the past, it's been time to start getting defensive on stocks. I mean, the reality is big gains are made when there's a lot of pessimism. And frankly, big losses are made when there's a lot of optimism. There's a lot of optimism right now. So it's just common sense, but it amazes me, having gone through so many cycles over 35 years, how often people forget it. And when the market goes up for an extended period of time, it's just hard to stay disciplined. On the bright side, unlike a year and a half ago, a lot of these income areas look pretty decent. I'm not saying we're going to make the kind of money we did coming out of '09, but they look pretty decent. And what's interesting is that even though you might say, well, I don't really care about a 2.7% yield on a 10-year treasury, it is amazing looking around the world what the other bond markets are yielding. And by the way, the Fed is not buying Spanish bonds, which yield 3.5 right now. Italian bonds yield 3.5% right now, and these are 10-year bonds. French bonds are 2.25, aren't they, Louis? Somewhere around there. So when you look at the 10-year Treasury at 2.7, it's not at all out of line. In fact, I'd argue it's cheap relative to a lot of those other bond markets. We do believe it's time to hunker down a bit with some of the equity-like investments and really focus on what Buffett has said so many times. Rule number one, don't lose money. Rule number two, don't forget rule number one. So we think that's a real, I mean, that's certainly true on the equity side, but we think it's also true on the on the income side. Another positive for bonds. I mean, one of the amazing things, we talked about this morning in an interview we were doing. I mean, the number one reason the Fed did QE1, QE2, QE3 was to lower interest rates. So here's a chart of interest rates. So when they started QE1, interest rates were about where they are now. They were about 2.7%. They did go down for a while. When they stopped them, they went up to 4%. Then once they phased out QE1, actually when they phased it out, the rates went back down. What's interesting, if you look at QE3, when that started, the rates were about 1.6, 1.7%. So with that last $1 trillion that the Fed has created, interest rates have actually gone up materially. So if their number one goal was to lower interest rates, you've got to say it didn't work. And if their number two goal was to stimulate the economy, you got to say, well, maybe that worked, but not great. So we actually point out, unlike most people out there, most investors who are saying, when the Fed quits buying treasuries, watch out, interest rates are going to go up, this would indicate that's not the case. And it's certainly not what we've seen since they've started talking about taper. Now, could the economy, we've only got a few economic slides here, but could the economy take off and really clobber bonds? Because that's what happens. If you get very strong economic activity, interest rates go up. Well, unfortunately, what we're looking at in the country is a decline in the GDP growth potential. It actually has been coming down for years and years. It's not just recently. It goes all the way back to 2000, as we'll see in a moment. And we do have a problem with productivity. We've got a slower growing population. It's just, we're a more mature economy. It's just kind of reality. The other thing that, and I know Louis believes in this very strongly, that's really a problem is with all this free money that's been created, companies, instead of investing in long-term things like plants, new equipment, they've had a tendency to buy back their stock. They've had a tendency to merge. When they merge, they cut jobs. That really hasn't been what the Fed wanted, but it's what's been happening. And that's not great for future growth either. If we look at what's happened in the labor force, it's, we've got 92 million able-bodied Americans that are not part of the workforce. If you look at the number of people on food stamps, welfare recipients, disability seems to be an epidemic around. I mean, this is supposed to be a recovery. This has never, ever happened before. So we definitely have a situation of too many takers and not enough makers. The joke of 5 or 6 years ago was we were a bailout nation. Well, now we've become entitlement nation. And that, if we look at the latest estimates with the ACA, the Affordable Care Act, and the minimum wage, that's supposed to cost another 2.8 million jobs. And that's the last thing we need. So we've got some major headwinds that we put in place. And frankly, if it wasn't for the fact that so many people have dropped out of the workforce, the unemployment rate would be over 10% right now. And the chart on the right shows this drop in the growth rate, basically half of what it used to be. And maybe that will change, but given the policies we have right now, we're worried about that. We're worried that we're going to be looking at a lower growth rate for a while. So just as I wrap up here, remember 5 years ago when so many other investors were in the fetal position, we were bullish. I'm not trying to be Davy Downer because I do think there's opportunities. There's opportunities in the income world, there's opportunities overseas, but we have to be realistic about the valuation of the U.S. stock market. I do believe America will get its act together, but unfortunately right now, it's kind of like the Fed is anesthetized everybody with all this printed money, so there's not the urgency that there needs to be. So our plan, frankly, is to hunker down and seriously be prepared to go on offensive during the next panic, and it will happen. I don't know if it's going to be this year, but it will happen, and we want to be buyers when that occurs. So in the meantime, we're just going to focus on some of these yield instruments that I mentioned and play defense as best we can. Thank you very much. And
please hold your questions till the end. If you haven't figured out, we're going to do a panel with Q&A after our 3 formal presentations. And also, I forgot to mention, we did take the restraints off the chairs this year, so if you'd like to freshen your drink, the bar, Lindsay, outside is open. So probably wait until Grant goes and listen to Louis and then do it. Okay, Dave, thank you. So in 2012, Evergreen Capital rebranded to Evergreen GovCal, and we're excited and grateful to have Louis Gov, the founding partner and chief executive officer of GovCal Research, and he's the principal of Evergreen GovCal as well. In 1999, Louis co-founded GovCal Research and set up headquarters shortly thereafter in Hong Kong with the belief that that's where the next global growth wave was coming. GovCal subsequently became one of the premier research firms in the world and launched a very successful money management arm. Louis has written several books, including one that we are giving away somewhere out there. If there aren't any, see me after. It's called Too Different for Comfort. I don't have one, but that would have been nice. It's, again, my pleasure to introduce the man that Bloomberg called the smartest man in Asia, Louis Goff.
Thank you very much. Well, I guess I'll kick off, starting off with Tyler's remarks, because they reminded me of a Russian saying. The Russian saying that goes something a little like this: "The church is near, but the road is icy. The bar is far away, but we can walk carefully." And so I arrived yesterday night from Hong Kong. Grant arrived from Singapore, and I think you'll agree that's pretty far away. And I think this distance is a testimony to the respect, the friendship, the admiration that Grant and I have for Dave, for Tyler, for Jeff, for Nick, and for everyone at Evergreen. It's a terrific, terrific team. It also is a testimony to the fact that Dave does not run a church and that there is some booze outside. Dave asked me to speak about China, speak about Japan, speak about what's happening in emerging markets, and to do it all fairly quickly. So I'm going to start off. It's actually, I was happy he asked me to talk about that, because it really goes to what I've been doing for most of my career. I imagine that a lot of you in your respective careers have probably met people who've managed to have pretty much just one idea and managed to have a whole career out of them. I'm pretty much that guy. I had a very simple idea in 2002. It was that China was developing fast, and that all we needed to do to make money was just front-run the Chinese. That whatever the Chinese were going to buy, you needed to buy it first. And with that idea, you could build yourself a very diversified portfolio. You could buy real estate in Vancouver and in Hong Kong. You could buy stock in Porsche or LVMH. You could buy Bordeaux wine. You could buy Chinese modern art. It didn't matter. You could buy oil, copper, or gold. If the Chinese wanted it, you needed to get there first. And this corresponded to two very important economic realities. The first economic reality was that over the course of the past 10 years, China's labor force grew by 200 million people. Put things in perspective, there's 158 million workers in the US today. So over the course of 10 years, China added more than an entire US labor force. The second structural factor in China was that over the course of 10 years, you had a massive expansion in balance sheets. And I would say expansion in balance sheets from the top down, from the central government to the provincial governments to the municipal governments to the state-owned enterprises, private enterprises, and individual. Everybody expanded their balance sheets. Now, frankly speaking, managing money doesn't need to be very complicated. You know, all we have to do is surf credit waves. When you see bank balance sheets expand, usually good things happen. When you see bank balance sheets contract, usually bad things happen. Which brings me to China today. If the past 10 years the story was front-running the Chinese, that trend is now over. The labor force in China is no longer expanding. It's now flatlining, and it starts shrinking in 2016. The balance sheets in China are no longer expanding. The balance sheets have been shrinking, and this is very much a government policy that, if you just spend 2 minutes listening to the government, is clear as day. So, as an investor, I'm confronting the somewhat challenging position of having to come up with a new idea, having milked this first one for all it was worth. And I'm not, you know, perhaps I won't be successful in this transition, but let me start off with a potential idea, because I think it is an important one. And that is that one of the most important macro changes that our world is going through today is the improvement in the US trade balance. On your chart here, you've got the trade balance in the US, blue line, used to be 6% of GDP, trade deficit, now 3% of GDP. The black line is ex-oil, and the red line is ex-oil and ex-China. Why does this matter? It matters because the US dollar is the world's reserve currency. And so when Korea wants to trade with Australia, they both need US dollars to trade with one another. When South Africa wants to trade with Brazil, these two countries need US dollars. And how do these countries get US dollars? They get dollars through the trade deficit. Every year, the US sends abroad $300, $400, $500, $600, $700 billion that allows to grease the wheels of global trade, allows Finland to trade with Taiwan and South Korea to trade with Indonesia. But look at what's happened in the past few years. Thanks in part to the shale gas revolution, thanks in part to the manufacturing renaissance in the US is now sending fewer and fewer dollars abroad. And what does that mean for the guys on the other side? Well, it means, as we're now seeing in emerging markets everywhere, that all of a sudden, the dollars you used to get easily for decades, all of a sudden are scarce. All of a sudden, you can't get your hands on the dollars you need to trade. And so your central bank reserves start to shrink. And the blue line here is very simply, the red line, sorry, very simply is a piece of data that's published by the Fed every Friday, and it's reserves held at the Fed for foreign central banks. And that's the year-on-year percent change. And what you see is each time reserves start to shrink, whoever runs current account deficit or whoever is extremely leveraged goes bust. And sure enough, right on cue this year, we have reserves start to shrink in April. And right on cue, emerging markets hit the skids starting in the summer. Now, which brings me to today. Today, you have a number of emerging markets that have been selling off aggressively. Turkey, South Africa, Brazil, Argentina, Venezuela, Ukraine, Egypt, you name it. A lot of emerging markets hitting the skids. Now, historically, when emerging markets hit the skids throughout the 80s and 90s, what would happen was the US consumer would expand his balance sheet and import more from the rest of the world and export dollars, which would allow the emerging markets to stabilize. Today, what you're seeing is the markets telling countries like Turkey, like Ukraine, like South Africa, that are running current account deficits of more than 5% of GDP, the markets are telling these guys, you have to adjust and move back into a surplus. The problem, of course, is that trade is a zero-sum game. If Turkey needs to move from -7% of GDP to zero, it needs to do it against somebody else. Which brings me to the first question I would ask the audience is, who do we think emerging markets are going to adjust against? Historically, it would have been the US consumer. But today, partly because of Fed policy that keeps the US dollar undervalued, partly because of the shale gas revolution, partly because of the manufacturing renaissance, the US trade deficit continues to shrink. So it's unlikely that the emerging markets can adjust against the US. Maybe they can adjust against against the EU. And if you believe that, I have a bridge to sell you. Maybe they can adjust against China. This is what we witnessed in 2008. China in 2008 stepped up to the plate and said, you know what? I'll have a big stimulus bill. I'll move my current account surplus from 6% of GDP down to 1% of GDP, and I'll leverage up. Today, if you listen to the Chinese leadership, they're very clear about this. This isn't going to happen again. Which leaves you with the question, who out there is big enough for these emerging markets that are today in trouble to adjust? And I'm going to propose two possible options as to how this we go back into a positive equilibrium from a negative equilibrium where basically countries are just pushed into recession. The first positive solution is that emerging market countries start to move away from trading in US dollars and instead adopt a new currency. And here the new currency is obvious. The potential choice is the renminbi. Few people realize this, but over the past 3 years, the renminbi has actually been the world's strongest currency. And it's been the strongest currency and the best performing bond market. If you look at this summer, when every bond market was collapsing, Chinese offshore bonds that anybody in this room can buy, actually sailed right through. Last year, you could make, by taking not very aggressive risk, you could make 8-9% on RMB bonds with about a 2.5% volatility. Now, anybody who's been in the markets long enough knows that these kinds of 8-9% returns with 2.5% volatility, that's just not natural. It just doesn't come about. That's an obvious direct consequence of the market being manipulated. And being manipulated by who? Being manipulated by China. Now, why would China manipulate its bond market so that everybody in this room can have nice, stable returns? Is it out of the goodness of their hearts? No, believe it or not. It's because China is very keen to promote the RMB as a strong, stable currency and the RMB bond market as a natural store of wealth for emerging markets to keep reserves in and hereby move its trade away from US dollars into renminbi. And China is being successful at it. In just 3 years, China has moved from 0% of its trade denominated in renminbi to 20% of its trade denominated in renminbi. Now, why would China do that? The first reason is, of course, the lesson of 2008. In 2008, China's exports all of a sudden moved from a 25% annual growth to a minus 25% growth. And so China turned to Indonesia, Korea, Thailand and said, why did you guys cancel orders? To which Korea responded, when Lehman went bust, trade finance froze, we couldn't get our hands on US dollars, we couldn't trade with you. Without dollars, we can't trade. So China says, this is really silly. Because American banks have been badly managed and badly regulated, all of a sudden, you and I can trade with each other. You know, why are we stuck in this ménage à trois thing with the American bank in between us? We're not even French. Let's have a committed relationship. Let's have a committed relationship and trade in renminbi. To which more and more countries are, of course, saying yes. Now, the other reason China is doing that is because it allows China to move up the value chain in terms of its exports. When we think of Chinese exports, we tend to think the stuff we buy at Walmart, the cotton underwear, the toys for the kids at Christmas, and whatever else. Increasingly, China, when you talk to the Chinese Ministry of Commerce, they tell you, our growth for the next 10 years will be selling telecom switches to India, earth-moving equipment to Indonesia, and oil rigs to Russia. And when you move into that business, you need to provide financing for your clients. Hence the need to create a deep capital market, which brings me to China's single biggest comparative advantage that nobody thinks of. If I ask you, what's China's big comparative advantage? You're probably going to say cheap labor or having a very large economy. Forget it. Chinese labor isn't that cheap anymore. China's big comparative advantage is that alone amongst any emerging market, it has a deep liquid financial center that people can trust. And here China was amazingly lucky because the Brits built it for them. And the Brits are pretty good at building financial centers. So the Brits built Hong Kong, give back Hong Kong to China in 1997, and China does nothing with it for 12 years until the financial crisis hits. And China realizes we have to use this to break our dependency on the US dollar. And this is what is happening today. This is what's happening in front of our very eyes. And it's a transition somewhat similar to what Europe had in the 1970s, where Europe moved away from its dependency on the dollar and moved to the Deutschmark, which made assets in Europe much more interesting for many reasons. It made assets more interesting because all of a sudden, you weren't dependent on the US financial cycle anymore. Look at it this way. The world of yesterday was an Indonesian coal mine buying a Caterpillar machine financed by Citibank. And if ever something bad happened in the US, Citibank would tell the Indonesian coal mine, give me my money back. And activity in Indonesia would collapse. The world of tomorrow is a world where the Indonesian coal mine buys a Longheur machinery financed by an Indonesian bank that goes and issues an RMB bond in Hong Kong bought by Asian savers everywhere. In other words, Asian savings financing Asian growth. And in so doing, Asia starts to have more of its own independent cycle, gets a lower cost of capital, and a more stable source of capital. And that means a re-rating of assets. This is why, as I look at today, the sell-off across Asia, but at the same time, I look at the financial changes that are happening in the very financial infrastructure of our region, I can't help but think that this is a tremendous opportunity. Indeed, there is always what you see and what you don't see. What people see today is what I started with, the slowdown in China. What people see today is the challenges that emerging markets face. What people don't see is how these challenges are being met. What people don't see is the cheap valuations that are prevalent on most Asian assets today. And what people don't see is the opportunity set for the region is being amplified dramatically as the dependency on the Western world continues to diminish. And on this, I'll pass on to Grant. Thank you very much.
Our final presenter, not unlike Louis, has become a deep-rooted advisor to the firm. Grant Williams, based in Singapore, as Louis mentioned, also has unlike kind of like Dave, quite a few years under his belt. I was surprised to read 28 years experience in the investment industry. He launched in 2009 a newsletter that I'm sure many of you have seen called Things That Make You Go, He originally distributed it to a few colleagues and friends. And today, I think the term viral has never been more apropos. He's got almost 1 million subscribers. So Grant is a good friend. He's a brilliant guy. Although I don't, to the best of my knowledge, Bloomberg has never once called him smart. It's a pleasure to have him here today. Thanks, Grant.
Thanks for that, Mark. That was one of the best introductions I've ever had, actually, funnily enough, which says a lot more about me, I think, than Mark. Now, I've brought my own laptop here, so if this doesn't work, just shout out if slides don't move when I'm talking about them. I want to thank these guys here for having me. As Louis said, they're good people. They really are, and they're smart people, and we've become close over the last few years, and I'm continually impressed by the job they do, the thought process that goes into what they do. And it's, as I say, it's a privilege to work with these guys. They really are some of the best out there. Having said that, I'm now going to hopefully not bring you down too much. They've told me not to be too miserable about this stuff. I get this reputation for being a pessimist, which is not true. I'm an eternal optimist, but I like to think I'm more of a realist. And they only gave me 15 minutes, and I know Mark's going to give me the hook if I go over, so we'll get this thing started and see how we go. Does this work? Here we go. Okay, so as we entered last year, there were a whole bunch of things that could have derailed the world, and everyone was talking about them. We spoke about them here last year. But in the end, all that seemed to matter was how much money was printed, or as Dave said, created by the Fed. And perhaps more importantly, the amount of confidence that the world had that A, they would continue down that road, and B, potentially expand it if things got worse. As the end of the year came around and the dust had settled, equities had banner years right across the world. And it wasn't just equities, asset prices, everything from art to wine to real estate in all kinds of funky places, and even a tuna fish, all outstripped previous record bids. At the year end, all the reviews in the mainstream media were talking about the stellar performance of equities and the resurgence of the US housing market, and they were the two big stories. Beneath the stories of those, it's a slightly different story. At least some of the things that are going on underneath need to be understood before you make investment decisions in 2014. So I'm going to run through just a few of them and see if we can work out where it all went right. Now, the inspiration for this little presentation came to me from this guy here. This is a guy called George Best. Now, talking about football, and it is called football, folks, just so we're clear on that, in America is a dangerous thing to do. But this gentleman, if you don't know who he is, shame on you. This is George Best, arguably the finest football player who ever lived. But Best had a somewhat checkered personal life. And the charge laid against him was that this was an incredibly mercurial, talented guy who basically took that talent, threw it away, and ended up, instead of a legend, as something of a hard luck story. And the reason for this was that along with that prodigious talent that he had an insatiable appetite for women and booze and horses and women and booze and women. In fact, Best actually is the only man I know who dated three Miss Worlds. And the inspiration for this presentation involves a story that he told himself on a speaking tour a number of years ago with a woman called Mary Stavin, who at the time Best was dating, and they had an on-off relationship for a few years, was the current Miss World. And the story goes like this. Best and Stavin had been out in London for dinner, and they went to a casino where Best won £25,000, which back in the 70s was a lot of money, in a casino. And so he took the cash with him, went back to their suite at the Savoy. Best picks up the phone, calls room service, and orders a bottle of champagne, the finest Dom Perignon, and 2 glasses. And about 15 minutes later, a little Irish bellboy comes up to the room and knocks on the door. The door's opened by Best, stripped to the waist, and he starts to sign the chit. And as he's signing it, the little bellboy looks over George's shoulder, and on the bed behind him, he sees Miss World in her underwear and £25,000 in cash spread all over the bed. And George Best thanks him, leaves a generous tip, and as he's closing the door, the little Irish bellboy puts his foot in the door, and he looks him in the eye, and he says, "Tell me, George, where did it all go wrong?" And that story was the inspiration for this story. However, despite all this larrikin behaviour Best had, was capable of moments of great poignancy. And one of the most famous things he ever said was that when he was gone, people will forget all the rubbish, and all that will be remembered was his skill at football, which obviously was completely wrong because I've just told you a story about all the other stuff that went on. But he was a hell of a footballer. If we look at economies across the globe in the last couple of years, I think it's also important to strip away this veneer and try and understand what's going on beneath the surface. So I'm going to look at a few things that went on last year, and hopefully they'll give us some pointers going into the next year. Now, Dave's talked about this already. This is perhaps, I think, arguably the most important chart in the world that people need to understand. And this is the expansion of credit, if it comes in, here we go. The expansion of credit in the United States versus GDP in the same country from the 1920s through World War II to the present day. There's a couple of very important things that this chart demonstrates. The first is the fact that the vast majority of the growth through that 20th century and into the 21st was, in fact, credit expansion, as the two guys before me have already touched on, and it wasn't GDP growth. The second is the relative size, as you can see there, of the global financial crisis that took place in 2008. As you can see, those events, which I'm sure we'll remember almost quote-unquote collapsed the system, whatever the hell that means, were in the grand scheme of things relatively small. Not only that, but in order to stabilise that meltdown, the expansion of credit had, and I mean had to, not just stabilise but continue growing fast, and that's what's happened. The curve of GDP growth, as you can see here, is actually consistent and reasonably shallow, but the growth in credit required to maintain that shallow growth in GDP was becoming ever more parabolic in trajectory, and I think we all know in this room what happens when things go parabolic.
Things are not what they seem.
No, they're not what they seem. Excuse me, I've got a bit of a cough. So we're going to dig a little deeper into the reality behind the numbers that are being touted around the world as a recovery. And we'll begin, of course, with the economy itself. Now, the past year, the Fed tied itself and its stimulus programs, rather foolishly, I thought, to the unemployment rate. They were forced very quickly to backtrack that, and now they've scrapped it altogether because it tumbled far faster than they'd actually anticipated it would when they made that explicit link. And the reason for that is this chart here. Dave touched upon it again. This is the labour force participation rate. And what this shows us is that people have been falling out of the workforce at a record pace. Once you're classified as not looking for employment in the United States, you're taken out of this number. You're taken out of the workforce, and you're not included in what's called the U3 unemployment rate, which is the headline rate that we all read in the newspapers. And as you take more and more people out of the workplace, obviously you bring down this unemployment rate, and that's why this has fallen so fast. It's not people finding jobs; it's people stop looking for work. There's a couple of other unemployment facts I've written down here that I was reading today. There are currently 1.1 fewer Americans today working than there were in November 2006. And during that time, the population has grown by 16 million people. So as you can see, that's a problem that's going to keep manifesting itself going forward. The number of working age Americans without a job has increased by 27 million since the year 2000. And Dave said there's about 90-odd million able-bodied workers not in the workforce. And in November 2000, there were 64.3% of all working age Americans had a job. When Barack Obama first took office in 2008, that had fallen from 64.3% to 60.6%. That's a huge drop. And from there, it's fallen another 2% to 58.6%. So the unemployment picture is actually pretty ugly here in the US, despite optically looking better because that headline number's coming down. And I think more and more people are starting to understand that a falling unemployment rate doesn't necessarily mean everything's okay. But what does that mean for GDP? Well, as you can see, hopefully this next chart's going to come in here. We're in the middle of the weakest decade for growth in over 2 centuries. Now, the decade is, I will admit, just a third of the way through. But even if we're going to try and reach that average there line, which is a 200-plus year average, we're going to need an explosion in growth in the US, the like of which we've never seen before, and I just can't see that happening. We've seen a recent slate of tepid at best numbers in the economy, most of which have been blamed on the poor weather in the East, which have led to seemingly constant lower and lower revisions of GDP over the last 12 months. Now, through that time, however, corporates have performed absolute miracles in squeezing the last drop of juice out of the lemons they've been handed. I mean, to an extraordinary degree, and again, this is something Dave touched upon. If you look at this anemic GDP growth and the success at cutting costs and generating admirable profits has led to that percentage of GDP that is corporate profits reaching an all-time high. It's extremely elevated, and this happened, unfortunately, against the backdrop of declining employee compensation, as you can see in that blue chart there. And this is, of course, completely unsustainable, particularly in an economy that's so reliant upon consumption for its growth. As I said, completely unsustainable. Now, corporate profit margins, as Dave said, have a habit of being very volatile but very cyclical, and they always revert to the mean. So if you take that chart, the red line there, and you picture a 70% reversion to the mean and the inevitable overshoot, as you can see, it's not pretty. It's definitely a time to hunker down and look for safe places to be. As I mentioned a while ago, through 2013, we saw almost continuous lower and lower revisions in consensus GDP, and these two charts speak to that. As you'll see, the blue line there is the consensus GDP for the US through the year, and the red line is the MSCI World Index, which I think one of the guys showed before, which is basically a global benchmark of equities. So despite, as I said, almost a 45-degree revision downwards in expectations for US growth, the stock market went up and up and up around the world, and that's never happened before. It's great for 2013, obviously, but potentially not so great for 2014 unless we can find some organic growth from somewhere. Equities. Last year was a banner year, up 34% for the S&P. Venezuela was up 480%, if anyone was lucky enough to be long of that and had their currency hedged, they would have had a hell of a year. But if we look at them, this chart, does that not work? Here we go. Here we go. This chart, for me, is incredibly illustrative, and it shows the flows of equity investing into ETFs and out of managed mutual funds. Now, the advantages of ETFs are pretty obvious. They're much lower cost, and QE has meant that people want to be long equities. They don't really care what that means. They don't want to do the work. They don't want to do the research and look for individual stocks. They just want to be long stuff because it's going up, and that's what's been touted. And look, that's what's happened. It's great. It's essentially meant the dumbing down of investing. Now, on the way up, this has been fine, because as things go up, there's always someone that will pay a higher price for something until there isn't. But on the way down, this increases volatility enormously, particularly with the amount of computer-driven trading that we're seeing on the exchanges now. Something like 70% of the volume that trades on the New York Stock Exchange now is driven by computers. When this trend reverses, and it will at some point, you can guarantee that, there really aren't any real buyers left, not at these levels. They're much, much lower down. And they're the smart money that Dave spoke about earlier on, waiting to look for value investments, and you're not going to find value at these levels. Now, I've spoken about the effect of QE on equities, and this next chart demonstrates that. I hope, if it's going to work. Here we go, beyond any doubt. Here we go. Now, this is the same chart that Dave had, but I wanted to talk about a couple of things around it. So the blue line there is the S&P, and the red line is the Fed's balance sheet. And Dave showed this correlation earlier on, but those rectangles there are very, very important. If you look at the first one, this shows you when QE1 first came in. You can see when they took that first giant leap in the Fed's balance sheet, the equity market continued to fall until we got capitulation at the bottom and all the panic selling was done. Once that happened, the market got the joke, and you can see there that the S&P started to rise pretty aggressively. Now, the next rectangle you'll see there, if you look at the Fed's balance sheet, you'll see it starts to contract. And you'll see that the equity market, as soon as they took away the stimulus, fell pretty hard. Then the market got the whiff that QE2 was coming in, and you can see there the market jumped considerably just before the Fed's balance sheet began to do the same. Again, sideways movement, Fed balance sheet, large correction in the market. What you'll see after the four rectangles finish is QE4. And that was a whole different beast altogether. And they realized that without giving the market consistency, you're always going to have these large rises and large falls. So we have a whole different chart there, and you can see it's going up at a very nice steady angle. Everybody knew that $85 billion a month was coming into the markets, and they could plan accordingly. And that made things much easier. Now they're starting to take that away, and I'll come to the taper in a second. Things could start to get a little bit squirrely again. If we move on to the next chart, all this sound and fury, and we want to see what that signifies, well, in the end, it actually doesn't signify anything. You can see here, this is the S&P 500 deflated by the amount of QE pumped into the system. And as you can see, what the QE has done has basically stopped the market falling any further. It's gone sideways for the last 5 years in deflated terms. That's not much to show for a few $1 trillion of extra money. Now, another way to look at the effect of QE is with this next chart. Now, this is QE going back to the dying days of 2008, and you can see how strong the market has been since it bottomed in March 2009. But if we overlay the various QE programs here, if that comes through, you'll see a different story. Now, I won't go into the color coding. You probably can't read it from the back there. I apologize for that. But basically, what you're going to see is the QE periods have accounted for a 95% rally in the stock market, which is great until you realize that the stock market only actually went up 80% during that time. And that's going to be a problem as the taper continues. Now, interestingly enough, we have been here before, and this chart is, it's really just for a bit of fun, so don't panic or anything. This is the Dow Jones from June 2013 to January this year, as you can see, very, very strong. And this is the Dow Jones between January 1928 and January 1930, just before the Great Depression. Now, charts like this are, I have to say, they're great for shock value, they're great for getting people think, and they're great for getting a point across. And they're scary as hell at face value. There are all kinds of arguments you can make about this. The point of me showing this chart is just to demonstrate how quickly things can change, and once they do change, how far they can go in the opposite direction. And these are the things that, I'm not saying this is going to happen, but people need to be prepared for. Dave's talking about hunkering down, and this is exactly what people need to do at this time, is to hunker down and wait for this to actually start, to demonstrate real reasons to buy things again. Either way, these markets, believe me, are no place for enthusiastic amateur investors. Now, I'll throw in one quick chart of the taper here. It's one of my favorites, and it puts the taper in perspective. Now, there's two possible newspaper headlines surrounding the taper. This is one of them, Fed to taper 10 billion per month. You'll see poor Janet looking very glum there. The other way of actually reporting the same story would be this one, Fed to spend 65 billion per month indefinitely. And obviously Janet looking a lot happier about life there. Now, obviously the former story was the one blanketing the media, but the latter is actually a much better representation of reality. Either way, as you can see from this chart, in the long run, it doesn't mean very much if I bring this up. So the red line here is the original 85 billion a month QE program. This next one coming in here, the blue one, that's with a 10 billion taper. That's the first taper going out to 2015. This one coming in now, the yellow one, that's the taper as it stands at the moment. And let's assume they taper another 10 billion at the next Fed meeting. That's what the Fed's balance sheet will look like at the end of that. So as you can see, at the end of 2015, we're still going to be way over $4 trillion on the Fed's balance sheet against a $1 trillion balance sheet just before the crisis hit, or just before the crisis hit. So you can see the taper, there's been a lot of sound and fury about it, but it really doesn't mean an awful lot in practical terms. What's really going to affect markets is the belief in the intention of the Fed, and that's going to play out over the next few months. I can see Mark out the corner of my eye giving me the evil eye, but there's one more slide I wanted to show you on Europe.
This could very well be the stupidest person on the face of the earth.
Not me, that's European politicians that was aimed at, just in case you're wondering. Now, Europe somehow, I don't know how, they got through the year unscathed last year, remarkably well, despite a downgrade in France, more trouble in Greece, more trouble in Cyprus, and even riots in Sweden, of all places, for God's sake. I didn't think that would happen. And everywhere you look, you hear the leaders in Europe hailing this miraculous recovery. What they actually meant by that was, rejoice, Europe didn't explode into a million pieces. That's a big difference. Now, if you look at this chart, this, I think, is possibly the most important chart around Europe that anyone needs to look at, certainly for the first half of this year. And this is the change in approval amongst the various EU countries in the leadership of the European Union. Now, in May of this year, May 22nd to 25th, every European country, or every member of the EU, I beg your pardon, has to have elections to represent the countries in the European Parliament. And as you can see here, with the exception of Germany, everybody's approval ratings of the EU are on a downward path. Now, I've left out countries like Latvia and Romania and Bulgaria for obvious reasons. I mean, the bloom is very much still on the rose there. They've only just come into this little project, and it's certainly better than what they had before. But every established European country is dissatisfied with the way that Europe is being run. And the problem you have there is that the parties across the continent who are making huge inroads in terms of the voting public, and it's true in Greece, it's true in Italy, and it's true in Louis' home country of France, are extreme parties, either right wing, left wing. The common unifying platform that they have is anti-EU and anti-Euro. And if these parties do actually take significant percentages of the vote and gain a lot of seats in Parliament, it's just going to make the whole process, which already is basically unworkable, impossible. You can't govern Europe with a significant portion of your elected representatives anti the project and anti the euro. So when those elections come around, people really need to pay attention to them, because far right or far left is not really as important as the fact that these countries are all anti-EU. Now, they told me to make sure you finish on a high note and keep people happy. So this last slide here is a cat and a dog that I thought you could all just take home with you. Very cute. And that's it for me. Thank you.
Thank you, Grant and Louis and Dave. What do we need? Oh, sorry. I wasn't going to steal it.
I know you. I was going to pause and watch that.
We are going to, it's your turn now to make them squirm. So if you've been thinking of questions, hopefully, we've got a couple Evergreen team members that are going to be walking through with microphones.
Mark mentioned how Louis has to leave early, so maybe
Yep.
we might want to skew the questions toward Louis. You have to leave.
Yeah,
in 20 minutes.
unfortunately, I personally have to leave in 20 minutes to catch a plane. So if you got questions on Asia, although Grant can easily take questions on Asia as well. But
Well, let's start there. A question for Louis. Hey, Joe, look alive.
I have a loud voice. What if the United States economy is, in fact, actually growing?
Okay.
Well, it is. There's no question. It is growing.
I mean, the impression I get from what everyone says, it's all about the Fed, and the Fed is talking to the market. And what if, as the Fed withdraws, the economy grows?
can I take
Jeff, well,
Can I take it?
you take it.
Yep,
Sure.
sure.
Take it.
Yep. Look, I think when you look at any economy, any investment decision, any investor, entrepreneur has to deal with 5 costs, right? You got your cost of labor, you got your cost of land, you got your cost of government, whether through regulation, taxes, etc. You got your cost of capital, and you got your cost of energy. Those are the 5 big costs that drive any business decision. And you're absolutely right to highlight that today, the U.S. actually has, at the very least, one brand new comparative advantage in that cost of energy. I think if we look through the 1990s and 2000s, the story was, around the world, was a labor cost arbitrage, where in the Western world, our labor costs were here, and in Asia, they were here. So all the factories were moving east, and now it's going the other way, because labor costs aren't that cheap over there anymore, because labor costs matter less and less, because we're automating more and more processes. And instead, what matters more and more is the cost of energy. Now, what's quite funny is that for 50 years, the cost of energy was the same all around the world. It was priced off a cheap barrel of oil. Then energy got expensive, and everybody looked for different answers. China went for coal, France went for nuclear, Germany went for wind, U.S. government went for solar power, U.S. private sector went for energy. And if today the U.S. has one major comparative advantage, it is just that. It is that in terms of energy, it has a domestic infrastructure, it has, you know, a fount of knowledge, a really huge energy industry that will find energy anywhere in the U.S. And today, that's, for me, the big catalyst behind the manufacturing renaissance here. So, yeah, no, the U.S. is is doing fine, I think. Is doing okay, is doing as well as it could given the circumstances. Next question becomes how much of that is reflected in prices? And that's where I think last year becomes very interesting. In that last year, all the 32% rise in the S&P 500 was a rise in multiples, not a rise in earnings. So it all you had was a PE expansion. And as you look at the coming year, with P's already pretty stretched, you have to wonder, okay, how do equities continue to rise here? Is it going to be because the Fed's going to print a lot more and get P's to go up? Doesn't look like it's going down that path. Is it going to be because earnings are going to be spectacular? Well, for that, you need just enormous growth. And right now, the data is not there. Is it going to be because interest rates collapse? Probably not, because if interest rates collapse, it means we're getting really bad economic news. So, right now, I don't think it's a problem as much on growth when you look at U.S. equities as much as where the valuations stand.
Can I just add something quickly? Sorry, Dr. Cahill. I think Louis' point about the 5 inputs, there's one thing that I would add to that, and that is, those 5 inputs obviously all relate and are dependent upon each other. If you have a big move in one of those, it affects decisions that businesses make on investment. And what's happened in the last few years is that the Federal Reserve have essentially manipulated one of those, which is the cost of capital. And so for businesses, they have to understand, and this is where this whole forward guidance thing comes in order for them to invest and be confident to do that, they have to know that that cost of capital is not going to increase materially over the life cycle of their investment. And I still don't think, despite what's happening, and you've seen more and more frantic efforts to generate that confidence in people, I still don't think that businesses as a whole believe that zero rates can last forever. So they're nervous about investing, which is going to definitely put a crimp on growth.
And Sheila, I just want to make a point is that we did say we think the U.S. economy is perking up. I think it's probably going to be the best growth year of the expansion. But just one little item for you to reflect on. I've been around long enough that I vividly remember the crash of '87. The U.S. economy in that quarter where the market imploded was increasing at a 6.8% real rate. And that didn't keep the market from falling, 23% in one day? So valuations do matter, and also when you get into very speculative environments, which we certainly had in 1987. If you remember, those of you that were involved in the market at the time, that was really the first go-around with computer trading. And as Grant pointed out, 70% of trading right now is done by computers, and that's, to us, that's very concerning. So economic growth and markets don't always go the same direction.
I'd add one thing also. I think sometimes when we have events like this, we talk about an annual forecast, so it's just next year, what are we looking at? I think the one consensus that our investment committee definitely has is that we are bullish U.S. long term. We think there should be a healthy correction to get valuations back in order. But like Louis mentioned, we think the energy boom that we're seeing in the Midwest is going to be huge tailwinds for the U.S. economy. We have fantastic advantage globally on our energy costs. We do think that there are incredible industries still in the U.S. that are going to grow. 3D technology, 3D printing is something that we think that we really hope that the U.S. will continue to encourage. And just the technology sector and continuing to be innovators in that area, whether it's cloud computing or mobile computing, for example, areas that we're really bullish on. So I hear that question quite often. You guys are always very bearish. I think that probably makes Dave very upset as well, because that's really not the case. We've been bullish equities, as Dave mentioned, in 2008 and 2009, and even in 2011 we got bullish at some point down in that correction as well. So we hear that all the time, and I'd say long term we are very bullish U.S.
That's Jeff Yulbert, Director of Wealth Management in case.
Thanks, Mark.
You're welcome. Louis, when you need to go.
There's a question right here.
Sure.
Yeah.
I'd like to follow up on your point there on PE expansion.
Yeah.
It seems like the Fed has indicated lately that they plan to keep interest rates low for a considerable period of time, like 10 years. Bill Gross wrote an article called The Great Deleveraging that argues they'll be low for 25 years. That seems to be a change from a year ago. If, in fact, those interest rates do stay low for the 10 to 15-year period, doesn't that argue for a multiple expansion beyond what we're used to seeing historically? In other words, now it's 17, but if you're going to have 4% money for 20 years, doesn't that argue for a 20 times multiple?
That's a great question. And the simplest answer I would have is obviously, we have very few historical precedents of long zero interest rate policies to go back to and say, oh, well, the one example we have, of course, is Japan. That's had 20 years of zero interest rates. And what has occurred in Japan? Well, the first thing, of course, is you never had a clear out of bad companies. You know, the one thing everybody talks about Japan is all the zombie companies that stay alive. That's, of course, the one downside of keeping the cost of capital at zero. It was Walter Bagott that said, you know, in a financial crisis and a recession, you want to lend freely but at a price, so that, you know, the good guys can get access to capital and basically take out the weak guys who are getting strangled. With capital priced at zero, nobody's getting strangled, which reduces the returns on capital for everybody and leaves you in an overall deflationary environment. And at least that was the experience in Japan, brings down, by bringing down the return on invested capital for everyone, also brings down the PEs. And again, that was the experience of Japan, but that's a sample set of one, which, as we know, statistically is not super relevant.
But to give you, I just want to give you a little backup on that, because even if you look at the United States and you go back at times when interest rates have been very low, PEs have been actually quite low. And the logic for that is just what Louis was explaining. Usually when you have very low interest rates, you have very sluggish growth. Look at the last 13 years, we've mostly had very low interest rates. We've had the lowest growth rate that we've had in 130, 40 years.
And we've had, Ps, except for the past couple of years, Ps that mostly came down in the past 10 years or so. But I'll go one step further in this, because I think here, this is at the crux behind the zero interest rate policy. If you look at the past 5 years, total U.S. corporate debt, if you look through the Fed flow of funds, total U.S. corporate debt has risen by $1.9 trillion. So companies have gone out and borrowed $1.9 trillion. What have they done with that money? Have they increased wages? No. Have they done a lot of capital spending? No. Total capital spending has been $450 billion. So $450 billion out of the $1.9 trillion. Where's all the money gone? The money's gone into share buybacks and into buyout of the competitors. Because a lot of you are probably entrepreneurs in this room. If you're given free money, you have two options. One option is to go out, build a factory, and hire a bunch of people and basically create economic growth, which is what the policymakers want you to do. The other option is to take the free money and buy back your shares. And in so doing, what do? You concentrate more and more assets into fewer and fewer hands, and you're doing so with more and more leverage. So you actually make your economy less and less stable. You know, if you ever manage money, you know that the fewer positions you have, and if you have them on more and more leverage, that's a recipe for, you know, you better be good with your timing, let me put it to you this way. Because, you know, if anything bad happens, your portfolio goes off the skids. And here, this is, of course, what we're witnessing in the US. More and more concentration of ownership with more and more leverage. And I think that's a very deflationary environment, because if and when you get exogenous shocks, and exogenous shocks just always happen, you know, recessions, whatever else, then all of a sudden you get fire sales all over the place. And you get workers that get fired, and you enter into, I tend to think that the zero interest rate policy is extremely destructive. And by being destructive, I don't see how logically it can lead to higher Ps. It's got to lead to lower Ps over time.
And that's one reason we pay, like Dave said earlier, a lot of attention to revenues. And if you've looked at revenue growth over the last 3 years since this market recovery, it's been very flat. And year over year, last year it was flat, or was it down?
About 1%.
1% revenue growth. So until we see actual revenue growth, it gets tough to pay these multiples.
I have one write-in question that I got from outside in the lobby, and that's what are the implications of a minimum wage hike? Maybe Tyler, I know you wrote a piece on that. You could give some background.
Thanks, Mark. I guess the first thing I'd say about the minimum wage hike is that probably most people try to quantify it. How does this affect me? And if you own a business and you have minimum wage employees, only about 2.5% of all Americans get paid the minimum wage. So you think, well, that's not going to affect the economy that much because it's only those select few. But 130% of American workers are within 150% of minimum wage. So the idea that you can raise minimum wage for the lowest skilled workers and not have a ripple effect and see that increase throughout the entire workforce, I don't think is that logical. I mean, there's no way that your lowest level employee is going to get a raise and your best highly skilled employee is just going to stand there and let that spread of income stay the same. So I guess there's the ripple effect. I think it'd be tough on small business. I think that the companies that are barely surviving, minimum wage is going to be hard on them. And I also think that you're going to hear more about this because the income gap between the wealthiest and the least wealthy Americans is expanded basically steadily for the last 30 years. And that, I mean, being blunt in politics, that plays well. When you're crafting a message, the idea of taking some money out of the corporation's fat profits to pay the lower wage workers more, that sounds good. And I think that on the surface it makes sense, but I think the idea that you can just pay these people more and the corporations are gonna be the ones that eat it isn't that likely. I mean, there's no free lunch. What it really would lead to in a lot of situations is higher prices for consumers. So I'm not sure that you're going to hear more about it. I think that it's coming to a state near you, but I'm not sure that it's
Very much so.
I'm not sure that it's kind of the perfect solution. I mean, I give the analogy a little bit that it's like waiting, having a pretty unhealthy life and not working out all that much and getting to be 60 and overweight and having a bad heart and then deciding you're going to get plastic surgery and get a bunch of stents put in.
Tyler, since Lou's got to leave soon, he's got a comment that he'd like to make about where perhaps governments can get a lot of revenue, like the state of Colorado is getting a lot of revenue with their new.
Hey, come on, I've cut my hair. We were discussing actually whether pods was going to be a new investment theme, and you're starting to see the pod stocks getting listed. Could easily be an investment theme, for the coming months or quarters. You've seen Colorado, in their first month, they were supposed to get about $10 million in revenue from the pod sales and for the government, and I think they've gone something like 132 million. So that, every governor is going to be paying attention to this and saying, "Wow, that's $2 billion a year that I can get in tax revenue here. That pays for a lot of schools, pays for." And as it's on the ballot, I think it's on the ballot. It's coming up in Alaska and California and Maine.
California's the big one.
In Oregon, so there's California's obviously a big one. So, the pod stocks there's like 4 or 5 pod stocks that are focused on pods that have been going crazy. I think they're going to go crazy for next year.
It's actually, there's a knock-on effect. I don't know if you saw, there was a story last week that some Girl Scouts set up a stall selling cookies outside one of the marijuana shops in Colorado.
Sold out.
Clean house, sold out in 10 minutes. So that's the spirit of entrepreneurship alive and well in America today. God bless them.
So we're adding this to our annual. We're adding this to our annual forecast. There's going to be a pot ETF coming soon.
You have a question over there, Joe?
Just a brief one. Do you have any comments on the output gap for the United States and the length it's taking to close it, and what happens if we go into recession before we close it? For Louis.
To me, or I'm not a specialist on the U.S. output gap. I imagine that a lot of it is probably historically, in most of the Asian countries, a lot of it is linked to the automobile sector and the machinery sector, which could very well be sectors that are in structural transitions. I think if I look at the U.S. In general, you have 2 huge sectors in the economy, most notably retail and autos, that could be beginning a structural decline and transition as autos move towards electric and as retail increasingly moves to the internet. You see it in the headlines every day, right? Macy's firing 5,000 people, JCPenney closing half their stores. And as a result, if you've got 2 huge industries that are in structural decline, what does an output gap tell you? It might not be a good reading, but again, I'm not a specialist. Perhaps these guys have better answers.
I'd say if you look at the labor market as a way of measuring the output gap, because it's not just plant and equipment, it's also people, I think labor market's actually getting fairly tight. I know that sounds weird based on what we said earlier, but I think that a lot of the folks that have left the labor force are probably not very employable anymore. So you are starting to see tightness in certain sectors, and that's why you're starting to see compensation go up. And that's not bad. I mean, that actually will help stimulate the economy. Of course, it's going to be a little tougher on the corporations, and especially since they're going to have real difficulty passing along price increases. And it's a very competitive world out there right now and getting more competitive all the time. So in some ways, I think there's some tightening going on in certain industries. I mean, look at the airline industry, for example, because they've taken so much capacity out. I mean, have you noticed any great deals on airfares lately? Maybe a few, but certainly not Alaska Airlines, it doesn't seem like on the West Coast. So I think Louis making a great point that there are some major structural changes that are going on. They're going to be long-term drags. Unfortunately, we see some other ones. But right now, things are starting to look a little tight, and that's what you would expect after several years of even a modest expansion.
Jeff, you have a question?
Regarding Japan, is the yen carry trade going to keep unwinding? It's been unwinding a little bit this year. Do you think that's going to continue? And if so, how will it impact like assets in the United States?
No, I think the yen's heading much, much lower. The way you have to look at Japan, I wanted to talk about Japan, but I ran out of time. But the way you have to look at Japan is that Japan is a profoundly mercantilist country. A profoundly mercantilist country. They don't want to run trade deficits. They want to export more than they import. And basically, they started to devalue their currency. You know, the whole Abenomics, 3 arrows thing, etc. It's all code word to hide the fact that all they're going through is a competitive devaluation. That's it. That's the economic program. Devalue until we get back to a trade surplus. And print aggressively until the yen falls enough that we get back to a trade surplus. And they're going to keep doing it until they get back to a trade surplus. And they're not going to get back to a trade surplus for another 2 years. And so they're going to keep devaluing the yen for the next 2 years. So, I'm personally very short the yen, and I would advise all of you to be very short the yen. The yen's going much, much lower.
And maybe some of you realize in the audience that are clients, we've been doing that for a couple of years. That's been one of our better hedges.
Thank you. That was an excellent presentation. It was very educational, especially for me. I'm entering into this kind of market. My question for you is that, what is the play? It's obvious that quantitative easing has created a bubble, and it's replaced the housing market bubble. So what's going to happen next? So do I want to put my money into stocks? Now, obviously, no, it seems to be get out because it's going to crash. So in 2015 is the time to move into something else. And what would that be, and approximately when?
You got that one, buddy. You got that one. It's all yours. You got to leave soon. You better take that.
I was going to say, I got to leave. No,
would be a good time.
Look, the obvious play is, I think that I've written this book where the main theme is we live in an age of accelerating creative destruction, where a lot of the trends that kind of used to unfold quite slowly are now in acceleration mode. And I go through a lot of the macro trends. So all this means it makes for a world with a lot more uncertainty. And so the first obvious and kind of cop-out answer I can give you is you have to be very diversified. You have to be very diversified because brutal adjustments on the market will occur. Now, when I look at the markets, one of the conclusions I drew a long time ago is that there's 3 ways to make money in the markets. You run some kind of momentum trade, and today the momentum trade is very clearly U.S. equities. You can run some type of value trades. Today the value trade is emerging market equities and emerging market bonds. And you can run some kind of carry trade. Now, carry trades are great because they're low volatility, sort of clipping coupons, right? That's the polite way to say it. The other way to say it is you eat like a bird and you shit like a cow. And that you make 1%, 1%, 1%, and then you drop 50%. And in a world that's as discontinuous as the one that we're in, I would be very, very wary of trying to make too much on carry trade. So I think today the obvious return to the mean trades are more in the sort of some of the fixed income things that Dave does. The momentum trade, like I said, the emerging market, the other return to the mean trade is, frankly, Asian equities. The momentum trade, long US, long Japan, short yen. Those are my 3 strong momentum trades.
I would add something to that. Just a general point. because I think Louis is absolutely right about all of this.
Sorry, I got to run.
But I think in general terms, and this is absolutely going to sound like some kind of infomercial, but I swear to God it isn't. This is, without question, the hardest period to invest your money and protect your wealth in living memory, going back 100 years and more. And the one thing I would suggest is that you make sure that professionals manage your money. And I would say give it to these guys, and that would really sound like an infomercial. But
That's a good
but
one.
no, I don't know. But this is a time when day trading guys have been sitting at home making money hand over fist the last year, just buying stuff and it going up, and this is a big part of that ETF phenomenon where people go, oh, I hear that Japanese equities are going up, we'll buy the EWJ ETF, and that gives us a long position in Japanese equities. And those people probably don't realize that they have to hedge their currency, otherwise they end up losing money. And professional investors, if you look at returns of hedge funds, for example, in the last year, some of the smartest guys in the world who have compounded double digits for 25 years had poor performance last year. And they had poor performance because the signals are so corrupted and so confused right now, and stuff that they've been relying on for decades to dictate to them when to make investments, where to move, and how to position themselves aren't working anymore at the moment. I mean, they will revert like everything else does. But right now, the signals are so confused by this artificially low interest rate environment we're living in. Everything is built off the cost of capital. So if you interfere with that, you by definitely interfere with everything. So the smartest people in the world had bad years last year. And dumb investors, and I don't mean that pejoratively, I mean people that just go, I'm going to buy equities, had a great year. And the danger is in extrapolating that and assuming this stuff goes up forever. And Louis' rather quaint phrase is absolutely right. When these things stop working, they stop working in a hurry and they go very, very badly wrong. So my best advice would be to make sure the people looking after your money are professional guys that know what they're doing. It's a very dangerous time for amateur investors.
I just want to say, since Louis set the precedent of leaving, I realize many of you have been here 2.5 hours. Don't be at all embarrassed. If you need to head for the exits, go for it.
There are people at the doors taking your names off the badges, so take that off.
And the bar is open, by the way.
Sure.
I just have a quick question. What will happen to ETFs when the markets go down, and what are the plans for Evergreen's clients who have ETFs in their holdings?
Want me to do that?
Go ahead.
First of all, we have some ETFs that actually go up when the market goes down, and we've added to those recently. They were not fun to own last year. The one that we have the most conviction on currently is against small cap for all the reasons I articulated earlier. We have a number of ETFs that are bond related that also could go up or at least hold their own in the event of a major market break. One of the challenges that I was touching on briefly is that we own a lot of income securities that have been great performers over the last 5 or 6 years, but they tend to track the market. They tend to go with the stock market. And so those are the areas of the portfolio, whether they're ETFs or individual securities, where we're paring back and trying to de-risk, as I said earlier. So there are ETFs and there are ETFs. It's such a diverse world of ETF, and I was only partially joking about the pot ETF, because you can get ETFs that do just about anything these days. So I think the point Grant is making is during a rising market, it's very easy to just say, hey, I want to have a S&P 500 ETF, just buy the US market, or buy the ETF in small caps on the bullish side. Those are the kind that are really at risk when the market turns. Do we have some of those that will track the market? Of course, we're never going to get totally out of the market. That's not the way we operate. In fact, my big fear is in a couple of years, people are going to come up to me and say, hey, Dave, you warned us about all this stuff. How come we had any stocks at all? Well, we're not market timers. We've never tried to be that. But we do try to underweight when we see an environment of extreme greed, as we are seeing today. And then we try to get aggressive on the buy side when we see a lot of fear. Right now, there's a lot of greed and not much fear, which makes us fearful.
I don't know if you're talking about, there's been some recent articles talking specifically about some of the smaller ETFs that if they have poor liquidity, if they get rush selling, you can't get out. Before you know it, your ETF's down 90%. most of the, all of the equity ETFs that we own for our clients are very large ETFs that really wouldn't have liquidity issues or anything like that if that's what you're kind of concerned about. That's happened to some of the emerging market ETFs recently and some of the currency ETFs, and that's just not in our clients' portfolios.
I think there's a Brazilian ETF
Yeah.
which recently lost 90% of its assets in a week. And that was a function of people that had read that Brazil was going gangbusters and we want to buy Brazil. So, my point about ETFs is that at their most simplistic, there are means for people that want to be in the stock market to get in the stock market. There are a lot of ETFs that can be used very effectively for hedging purposes. But again, they're not the ETFs that you'll have heard of. You have to kind of dig into the weeds to find those.
Mark? We want to get Rennie at some point.
I was curious, earlier when Louis was talking, he asked me, there was two options. We spent all this time talking about currency going from U.S. to currency. He didn't talk about the other option. I missed something. There's two options. Did I miss something there?
Are you talking about when he was discussing the U.S. trade?
There's two options what can happen. I mean, he spent all this time talking about the currency.
Did you guys get that one?
Did I miss that? I'm sorry.
Call him in the car.
Yeah, call him in the car. Let's get him on this. Let me think about that one. I'll come back to you afterwards. I do remember him saying that. I don't remember what the quite what the context
trade
was.
deficit. They were saying the money has to come from somewhere, but I'm not sure.
Yeah, we'll come back to you on that one. Rennie.
Here you go, Mark.
So the statistics are showing us that the market's at some dangerous highs, and yet the general market doesn't seem to be paying attention to that. What are going to be, initially the concept of the taper was allegedly going to be one of the triggers for that. That really hasn't seemed to rattle people too much. What's going to be the trigger that's going to bring us down?
Fabulous question. Sure wish I knew. Our operating thesis, and when, especially when, the operating thesis we've had on the taper is that the Fed, I think the Fed really does want to try to get out of this jam that they're in. I think they realize they've printed themselves into a very tight corner. And so their plan is, let's try to do this in a measured way so we don't spook the market. But I believe at some point, Grant had that great chart, which I didn't bring up, but I really should have, is that if you look at this tremendous rally that we've had since the bottom 5 years ago, almost to the day, I don't know if you realize that, March 9th, I believe, was what I call the satanic low of 666 on the S&P 500. It really did. That was the intraday low. So we've had this massive, massive recovery over the last 5 years. Yet if you look at those times when the Fed hasn't been printing, the market's actually gone down. Now, to me, I mean, the 90% correlation, that's kind of a little bit of, wonk talk for me, geek speak, but I get the part that when they're not printing, the market goes down. So we believe what's going to happen is the Fed will continue to taper until the market goes down a lot. A little, I think they continue to taper. Now, could it be something else that triggers it? Absolutely, it could be something else that triggers it. But I do believe at some point the market is going to look at the conditions and say, oh my gosh, we really have no more money being dumped in the system, and guess what? The economy is just kind of okay. Again, we're not, to get back to what Sheila brought up earlier, we're not predicting a recession. There are some credible people saying that there will be a recession. We don't think so. We don't think the preconditions are in place for a U.S. recession. But there are some very bizarre things going on in terms of currency wars. I mean, everybody's trying to depreciate their currency. Talk about a zero-sum game. And that's one of the real, you think about Turkey, the depreciation they've had in their currency. What does that do to Cyprus? What does that do to Greece? That's it's kind of like what we had in the 1930s was a decade of currency wars. We've got currency wars once again.
And since the taper, that's really where it's showed up. And maybe it hasn't shown up in the U.S. equities, although we'd argue that January was a pretty volatile month. We didn't see anything like that in 2013. But in the emerging market currencies and in their bond markets, you've definitely seen quite a lot of volatility.
I think I'd add one thing to that. That's that the taper, they've tapered twice now, and they're talking tough about tapering again. And I think the market still thinks they'll blink. There's going to come a point in time when the market suddenly goes, oh my God, they're serious. They're really going to do this every time. That's the test. So I think to say that the taper hasn't really affected markets, we're a little premature for that. I think at some point there's going to be a realization that
we may see that this spring if the economic news continues to be poor and they can't blame it on the weather. Well, does the Fed step back in at that point in time and really what happens? So.
Question?
Absolutely. Yeah, look, financial...
Yeah, you might repeat that. I don't think most people
Yeah,
hear
in
what
case
it is.
anyone didn't hear, the gentleman, Michael, brought up the subject of financial repression, what it is and what the aims of it are and what's happening. I mean, look, generally speaking, what the central banks are trying to do is stop you getting any money from saving. They're going to bring interest rates down as low as they can. Net, you're going to end up with negative interest rates. And the idea is to get the money out of savings accounts and bank accounts and into what they call productive assets. What they really mean are risk assets. And I put a slide up, I think it was here last year, that is the simplest slide I've ever put together. And since I put it up, I've had at least a dozen people come to me and say, I hope you don't mind we borrowed your slide. And it was 2 blocks. And those people that were here last year will probably remember it. And it was the interest income on $10 million of US Treasuries 5 years ago, which was $480,000. And the same interest income on the same position in US Treasuries last year, which was $24,000. That's financial repression. That means if you've got $10 million, you can't put it in the bank and live off the interest. That's financial repression. And they need to do that. They need to get this money out into the market and productive from a whole bunch of people that really don't want to do that now. So it's a very dangerous policy, and it's in play in all the wrong places around the world right now.
Yes, economy, excuse me, the, I want to say this. Commodities haven't been very popular lately. I was wondering where they fit in the years to come here.
Things like your wheelhouse.
I don't want to hog the mic. I think a lot of that stems from China and this slowdown in China. So the trade that Louis was talking about, which is buy stuff China needs before China buys it, has, as he said, gone now. That takes a lot of the speculative froth away. And as China goes in terms of stockpiling raw materials, so goes the world for sure. They've been the single biggest driving force for the last decade. And that's materially slowed down. We're starting to see big stockpiles of iron ore in the ports in China, copper. They're starting to build up again. And a lot of that has been used as collateral. I mean, there are warehouses full of copper and iron ore in China that people have used as collateral to borrow money to play real estate and stuff. So that's unwinding. I mean, we haven't spoken about gold tonight. That's one commodity which behaves differently to the others, and it certainly had a very poor year last year, but is a whole different kettle of fish just because of the difference between the paper gold market, which is what everybody understands as the gold price, and the actual physical commodity. So that trades differently to all the others. But for sure, the slowdown in China. And look, China's something, and it's a shame Louis isn't here to talk about this, but Chinese GDP went from 12% to 10% to 7.7%, and now they're talking about China growing at 7%. And yet, for a manufacturing economy, when you look at their PMI, which is the Purchasing Manufacturers Index, is actually contracting. So if you've got an economy where the government is telling you is growing at 7%, and the manufacturing industry is actually contracting, that's a very worrying sign, and it suggests that China is not growing at 7% at all. And if China is not growing at 7% at all, you're going to see this in commodities. There's going to be pressure on them.
Just to chime in a little bit on what Grant said, if you look at total global growth from 2007, 2012, half of it was driven by China. So a China slowdown is a big deal.
I see the crowd dwindling. Maybe a couple closing comments, if anyone has them.
I'm hogging the mic.
But you're good at it. You're good at hug.
You go for. We'll go down the line. You go first.
Since Louis is not here, we had him such a tight time leash, I thought I would expand on one of the themes that he didn't have a chance to bring up. He brought up the idea that from 2002 for almost a decade, one of the no-brainer investment strategies was to front-run the Chinese, figure out what they wanted to buy and buy it in advance. His new theme is that you want to think about what are the Japanese investors likely to do. And if you can be ahead of where they're going with their, and by the way, Japanese investors, Mrs. Watanabe, which is kind of in Japan apparently it's the
Joe Sixpack.
It's like Joe Sixpack because the women apparently control the investment portfolios mostly in Japan, and Mrs. Watanabe collectively is sitting on about 10 trillion US, which is actually more cash than we even have in this country. We have a lot of cash, but remember, Japan's about a third the size of the US. They have enormous amounts of cash. Talk about financial repression. The 10-year Japanese bond yields 0.7% today. So one of the things that Louis and the rest of the GovCal team believe is that money is going to start going places for better returns. And if he's right about, imagine if you're a Japanese investor, your currency is going down, you've got zero interest rates, you're either going to put it in their stock market, or you're going to think about buying U.S. bonds, perhaps Chinese bonds, dim sum bonds, perhaps U.S. equities, European equities. So that money is going to be migrating. And I think one of our goals, and we've been struggling with this a little bit, is figure out where is that money going to go. Because it is a huge pool of money, and I do think it is going to tend to be attracted to safe yield instruments, which fortunately is kind of in our sweet spot.
I think I'll just add something to that as well, if I may. The Japanese are very interested. I lived there for 3 years at the peak of the Japanese stock market and saw some very strange things going on. But the Japanese, as Dave says, they will look for safe assets, but a lot of that is going to be, it will be bonds, but it will also be things like real estate. The Japanese love real estate. The trouble with this is as that money goes overseas, the Japanese are huge buyers of their own government's bonds, which is the only thing that's kept the country alive, frankly, for the last 10, 15 years. If that money starts leaving the Japanese bond market and going overseas, it's going to create a whole feedback loop that's going to be a big problem for the Japanese, because without that support domestically, something like 90-something% of Japanese bonds are owned domestically, as opposed to the US, which is, I think, almost the inverse. So it will create a problem. So this capital, I think Louis and David are absolutely right, this capital will go overseas. We saw in the 80s when the Japanese went out and bought all kinds of, they bought Pebble Beach and they bought they bought the Rockefeller Center and all these big landmark property acquisitions. The Japanese love property. If the yen continues to deteriorate, if that money goes abroad, the Japanese have to print more money to support their bond market and the currency does collapse, that money is going to get sucked back to Japan in a heartbeat. Mm-hmm. So it's a very tricky thing to position. I mean, the smart trade, as Louis said, is short the yen, but short the yen is a 10-year trade that's very easy for people to get tricked out of at the wrong time, because it could go from 100 to 400, but it could go from 100 to 80 in between. A lot of people are going to get shaken out by that move to 80 and think it's all over. The Japanese cannot survive without a materially weaker yen, and what these guys are saying is they will continue to print, continue to expand their monetary base as long as the world lets them do it.
I guess the last thing that I'll leave you guys with is that I think probably the biggest risk facing investors is something maybe that hasn't been brought up tonight, which is the temptation to chase performance. With the equity markets up 16% 2 years ago, 32% last year, it gets really, really hard hearing about stock tips from your neighbor whose portfolio is up 70%. And it's true. I mean, we've written papers on this. The human brain isn't wired to be a good investor. We seek safety in numbers, which is a horrible idea if you're an investor. I think that really we start to doubt things that we know to be true when we see other people doing it, even if we know that it's wrong. And so I think that really having a rational investment approach and not falling in love with market returns and big numbers and stuff that we know that can't go on forever is probably the biggest risk facing investors.
And maybe that's a really good point that we didn't touch on. And Jeff Otis, this one's for you, that if you're not an Evergreen client, you are sitting in here with big gains in your stock portfolio, and you might have been 50% stocks 5 or 6 years ago, now you're 70, 80% stocks, and you might be 70, 80 years old, it might be time to rebalance. You might want to actually take some profits and recycle into much lower risk, higher income vehicles. So Tyler's right. There's such a tendency to, we talked about the way the human brain is wired. One of the things that is really harmful when it comes to investing is the extrapolation factor. You look at what's worked for the last 2 or 3 years and you extrapolate that to the next 2 or 3 years, that's a disaster. So on that happy note.
Put the cat and the dog sign up.
Yeah, put the cat and the dog sign. That's
right.
much more touchy-feely.
Can't get there. Well, thank you all for coming this evening.